Let's get into the individual stocks now and start with Tiger Brands, which is one of the largest manufacturers and marketers of consumer products in the Southern African space.
Right, under new management, it's beginning to pull back from its involvement in East Africa. It already exited its investments with Dangote in West Africa, and it's under new management and it's looking a whole lot better.
Market cap here, 79.5 billion rand, a PE of 19.4, and a dividend yield of 2.5%. And the new manager is
Lawrence McDougall.
McDougall.
Yeah.
Lawrence McDougall. Your thoughts, Nesan? One on the change in management, obviously Peter McLaren abdicating that post and heading off to Barclays ABSA, and now we've got McDougall.
Mm-hmm. Yeah, listen, I mean, I feel quite sorry for Peter. You know, he was the one that did the whole Dangote deal initially. And they ended up writing off, what was it, 1.5 or 2 billion rand in total over a period of 2 or 3 years. So, you know, the new management seems to want to focus on South Africa, whereas, you know, the previous management was into this whole Africa drive.
So undoing all the previous capital expansion decisions.
Absolutely. And, you know, it's difficult for Tiger Brands. They're the biggest operator locally. And in order for them to grow, they've got to do sizable deals, you know. And those sort of opportunities is not available in South Africa. So they end up being at the mercy of those soft commodity prices and the oil price, for example, in order to grow their earnings.
Well, let's put the share price graph up and then
Yep,
you
you're
can
going to
chat
see a
to
nice
us.
move up to the right because there are a couple of good internal things happening here. First of all, the year-on-year comparisons are looking better because the Dangote write-off is now passing out of the numbers. Secondly, we know that the drought has been broken. So things are looking a lot better, both in terms of the fruit business at Koo, that's in the Ashton operations, and it looks better for the basic, because this stuff, maize meal, Ace, you know, Tiger, still about 50%, Albany bread, about 50% of the group is the so-called sort of essentials or basic foods or grains, I think they call it. And then the rest is like Oros and mayonnaise and all that sort of stuff.
But is there further upside? Just looking at that share price graph, you would think, and we'll put it up again, that perhaps that's as high as it's going to go and that it'll be relatively tricky to realize more value off the current share price.
Yeah, so I share that view. I think it's had a great run. It's a very good business. And obviously with the drought subsiding now, soft commodity prices coming down, their ability to increase their margins compared to last year is definitely on the cards. But I think a lot of that's already been priced in.
Paul, there we go. Not such an exciting story
I'm
going
more
forward.
optimistic about it. I think, you know, McDougall came from Mondelez, I think, so he'd had international experience.
Beg your pardon, where?
Mondelez. Remember, that's the business that got spun off out of Cadbury's
Kraft.
or out of Kraft.
Yeah.
Yes, it's the sort of sweets business. And there are sweets, of course, in Tiger's portfolio, things like Maynards and so on as well. So I think the branded part of the business, Beacon Sweets is in there as well, is going to do better and better. And they're going to push that stuff more. The margins will increase. They're very solid and very experienced marketer. And I just think the group is on a roll now. And overall, I think the margin improvement is going to be bigger than people expect.
So from
I'm
your
inclined
perspective, onwards and upwards for the share price, hot or not?
I'm going to go hot on this one.
Nesan,
I'm going to go not hot on share price movement.
you're in my camp.
Fair enough.